So hi friends, my name is Chetan Pudar, and today I'm going to be talking to you about Dow Theory. This is one of the course material for investments, and today I'm going to talk to you about Dow Theory and about market participants and how do different market participants determine which way the prices move and what is that they do so that the prices move in a certain direction. So we are going to learn today as to who does what in the market and why does the market move. So let us quickly understand who makes up the market and who are the different people who are in the market and what is that, how is that they influence the market. So the first person is whom we call as smart money. Smart money are basically stakeholders. These are the people who have holdings in certain companies. Now they are there for a longer term, and they are basically the buy and hold type. So they act as business owners or somebody who is controlling businesses. There are also business owners, there are professional investors, there are a lot of professional investors. One of the professional investors could be Warren Buffett. He is a professional investor. They again are for longer term. There are a lot of fund managers. A lot of funds get managed, and since there are professional fund managers who manage these funds, they are also for a longer term. There are also long-term institutional investors. Different types of institutional investors get into the market. They are also long only, and when I say long only means they are basically buy and hold, and these are for longer period of time, right? There are also mutual funds, insurance funds, government investment. There are long-term investors who want to, there are long-term retail investors who basically invest for a long term, 5 years, 10 years, 12 years. And there are a lot of pseudo long-term investors. What I mean by this is that there are people who are long-term investors. These long-term investors have a certain backing of understanding which way the market works, but pseudo long-term investors are the ones who basically invest into the market and forget. So those are the people who buy and forget. Yeah, then there are venture capitalists, VCs are people, let me write this down for you. They are called as VCs. VCs are people who basically put money into the stock where at a very nascent stage, and they wait for the companies to grow about 500 or 800 or 900%. So these are VCs. Then there are a lot of midterm investors which come into play. There are pseudo midterm investors. Now these midterm investors would be the slightly the smarter ones. So let me kind of quickly write down smart ones who understand a little bit about what stock markets are. These are also smart ones, yeah. But these pseudo ones are the ones who have heard the term like long-term investing or mid-term investing. So they basically put money into the market and forget it and hope and pray to God that they are going to make money. And then there are something people whom we call as momentum traders who basically take care of the moment, which means they would be trading for about 1 month or 2 months. There are swing traders who basically catch hold of the swings. It would be anywhere between 3 to 5 days. I am a swing trader. There are professional traders who make money by professionally trading for other people. There are system traders. Now what are system traders? System traders are basically emotional less traders who have a certain system. One of the system which I could show you would be moving averages crossover system, which means every time the system gives a trigger, they will buy. Every time the system gives a trigger, they will sell. There is no emotion involved. They don't put their mind to it. So this is basically managed by a computer. Yeah, then there are short-term traders who want to quickly get in and out of the market. There are pseudo short-term traders who again, these short-term traders are the ones whom we call as smart short-term traders. They understand technicals, they understand trading, they understand, they work hard, they have learned it, they are educated. These pseudo short-term traders are the ones who don't do any of these things. They follow news, or they follow their friends, or they follow their brokers, and most of these people always end up losing money. There are ultra short term traders, maybe for 1 or 2 days. There are scalpers or jobbers. Scalpers or jobbers are extremely short term traders. They could hold their positions for 1 minute to 2 minutes or less than that. Then there is something, this is not traders, but this is a stop loss trigger mechanism, and as the stop loss triggers either as a buy or a sell, it creates artificial demand or supply in the market, which also affects the price. So this kind of quickly goes on and on and on, but these are the basic ones which I wanted to share with you. So if you ask me, why does the price move up and down, and the reason why prices move up and down is because all these people, in their endeavor to make profits and avoid losses, end up buying the stock and then selling the stock and then buying the stock again and selling the stock. So market basically moves because of demand over here and supply, and then demand here again and supply, by all these parties put together. So it is a collective decision of all these people who are trying to move the price. So very quickly, let me also explain to you what a Dow theory is. I'm going to explain it in a short. I don't want to go in detail. It has been taught to you in the class. What does Dow theory say? Dow theory says that market has three trends. There is a short term, mid term, and a longer trend. Yeah, market discounts everything, which means every news which you get in the market is going to be discounted. Yeah, whether there is a good news or a bad news, or there is a hidden news, or there is a news which only internal people know, it is going to be discounted. Yeah, the Dow theory has got four stages. One of them is called as accumulation, markup, distribution, and markdown. Yeah. The fourth point is averages must conform, which basically means to say is that Nifty index and there is a bank Nifty, and both of them have to be moving in the same direction for the trend to confirm. There has to be a confirmation also coming from volume, which means if the price is going up, let me show this to you. Yeah, if the price is going up, the volume has to support the price going up, and if the price is going down, the volume has to support the price going down. Yeah, that is what it means. And the last, the trend continues until reversal is confirmed, which basically means that till there is a reversal and it is a confirmed reversal, till that time we will have to say that the trend continues. So very quickly, let me talk about Dow theory, and this is the price diagram of any index or any stock. The time frame would be a larger time frame. We are looking at a time frame anywhere between 2 to 5 years. Yeah, and now as I explained the Dow theory to you, this is a little bit of a fusion theory which I would like to propose. Again, Dow theory is a theory, and Dow theory was written about almost 100 years back, and in 100 years there has been a lot of change, and because there has been a lot of change, I would propose explaining this theory in this particular manner, where it inculcates what is happening in the market at this point of time. So let us consider this to be the price, and as this is the price, let's call this as accumulation. So consider this as accumulation. There is what is called as a markup, there's distribution and markdown. So in accumulation, the price kind of moves sideways and then the price starts going up, and as the price starts going up, it's called as a markup. And as the price starts going up and it loses its momentum and it starts going sideways, it's called as a distribution. And as the distribution gets over, as the price starts coming down, it is also again called as a markdown. Yeah, and then the cycle repeats, and this again would be accumulation. So accumulation, markup, distribution, and markdown. Yeah, so let us understand, why does this happen, who makes it happen, how do we understand the situation better. Yeah, when there is accumulation which is going on, the news is really bad in the market. The news is really bad. People are very unhappy. The emotions are really sad. People don't want to put in their money. Everybody who has the money is already trying to sell off and get out of it. They have come to a stage where people are saying that I don't want to do anything with the stock market anymore. Yeah, that is the accumulation stage. At this point of time, the smart money is the one who is buying. Yeah, because in the stock market, we all know that you buy low and you sell high, but unfortunately most of us do not practice it. So the smart money actually practices this. They accumulate or they buy the stock when the news is really bad, and when the news is really bad, they get the stock at a much cheaper price, and as they get the stock at much cheaper price, they are the ones who buy it. Most of these people are for long term. So this is where there is a lot of bad news, and since there is a lot of bad news, all the people who are retail. There are always two types of people in the market. There are people whom we call as professionals, and there are people whom we call as retail people. 95% of the market is made up of retail people, 5% of the market is made up of professionals. Professionals are the ones who really understand the market. They take pain to understand it and study it, and hence have a clear advantage over people who are retail people. So 95% of the people always lose money, and so let me write this down. 95% of the people always lose money to the 5%, and this 95% are called as retail people, and this 5% we call as professionals. This is always the way it goes in every aspect of the market in every country around the world. So let's go further. So a lot of bad news. Who are the people who are buying? Smart money. The smart money are buying at a very, very cheap and a discounted price, and all of a sudden all the supply which was here has been exhausted. And if all the supply is exhausted and there is only demand, what happens to the price? Price starts going up, and as the price starts going up, we see a certain X amount of people who kind of get into the market. So let's understand who are the people who get into the market. So when the bad news is into play, the retail people are selling, the smart money is buying. Now smart money are the ones who have a lot of money, and hence they create a lot of demand. And since they do create a lot of demand, no supply, there is demand. What can happen? Price starts going up, and as the price starts going up, the people who first get into the trading system or the direction of the market are algo traders or scalpers who basically are into the market for a very, very short period of time, which could be 1 minute or 2 minutes. So they start feeding the direction of the market. Short-term traders get into the market, feed the direction of the market, they create demand, and as they create demand, price goes up. Mid-term traders get into the market, they further fuel the demand is created, no supply, price goes up. Momentum and swing traders get into the demand because they see a certain direction, further price goes up. Now this is where the smart money also comes in, which is the mutual funds. But mutual funds unfortunately are guided by principles which are very strict principles, and hence they can't really buy here. Once they start getting a direction, mutual funds get into the play, and as they get into the play, they actually create a lot of real demand. And now mutual funds are the ones who advertise on TV, isn't it? So who are the people who advertise on TV? Mutual funds, right? So they start placing ads on news and TV, and as it starts coming into the media, as news starts coming into the media, retail people start buying into the fund. So retail people watch a lot of news, and retail people start buying into the fund, and as they start buying into the fund, they buy into mutual funds, or they go and buy retail stocks. So this is a point where retail people get through mutual funds and through the retail operation like brokers and buy into the fund. Now as you can notice, as the price goes up, the demand is getting exhausted, right? The real demand, which is the serious money, is getting exhausted. And who are the people who are taking the market forward? It is the retail people, right? And retail people, as we know, are always the ones who lose money, right? So further up, now this is where we are here. What happens next? Now when we are here, let me just kind of place it right. When we are here, this is the time where smart money starts selling. The smart money has bought it here, and they have made a huge amount of profits, and as they make huge amount of profits, where do they sell? They start selling here. So this is called as distribution. They are slowly distributing and slowly distributing. Now here the demand gets exhausted because retail people really don't have the money. And who has the money? The smart money, the professionals, and professionals are selling, and as supply goes more higher than the demand, what do we see? We look at price start turning down, and as the price start turning down, who are the first people who get into the trade? Scalpers. They are the ones who catch the direction and start short selling. Algo traders start short selling. System traders start short selling. Short-term traders start short selling. Now when there is a lot of supply, all these people are creating supply, which is called as artificial supply. When I say artificial supply, I mean short selling supply. A lot of supply, no demand, price starts going down. Now at this point of time, this is very important to notice. What are retail people doing? Yeah, so retail people, they are busy averaging because they want to make sure that they are not wrong. So as the price starts coming down, they start feeling that they are getting stock cheaper and cheaper. So as the price goes down, they buy more. As the price goes down, they buy more. As the price goes down, they buy more. So higher supply, less demand. Somewhere down the line, a lot of retail people are basically giving up because they are sick and tired of markets going down. Yeah, and retail people never have the money, so they start selling mutual funds and cutting their losses at a very huge loss amount. Yeah, so this is where they start getting out of the market. Yeah, they start selling, further pressure is getting down, all this pressure goes in and the price starts turning down. This is where a lot of news has been discounted, but really bad news. And since it is really bad news, yeah, nobody wants to buy in the market. So where do retail people always buy? They always buy here. Where do they sell? They start selling here. What do professionals buy? They buy here. Where do professionals sell? They sell here. And this is the way I would like to explain the Dow theory, or a fusion Dow theory. So very quickly, let us again understand it one more time. Yeah, accumulation, professionals buying, huge demand is created, no supply, huge demand, price starts going up. As price starts going up, this is where professionals start selling. Retail people buying. As the price starts going down, professionals are further selling, and as professionals are further selling, who are the ones who are buying? Retail people. So as the retail people do not have money, higher selling, lower buying, huge supply, no demand, price starts going down and price starts coming here. And this again is the beginning of a accumulation phase. So let me write this down for you. accumulation, accumulation phase. So this is how I would explain to you Dow theory. So thank you guys, thank you for listening to me.